So a very quick look at the cash flow statement, how it works and how you might do a simple calculation on it. So the cash flow statement has a standard layout, which I'll put up as well, and you use that as a template for preparing it. So we use the income statement, but there's a number of things that are not actually used within it. So the earlier part of the profit and loss, and also the cash figures that are contained within the balance sheet and the retained earnings. So it's a subset of the figures that actually get used, but we identify each one. So the first one is the profit before taxation, which comes straight out of your income statement. We can link that with A here. Depreciation is added back because it's a non-cash item. So we go and find the depreciation in the balance sheet, and that's going to be the difference between the 2 years depreciation. So we have to subtract one from the other. Interest expense will come straight out of the income statement, and so you can see the interest expense there at C. Next, I'm just copying those over. You wouldn't always lay them side by side, but it'll actually make your calculation a little bit easier if you lay it out like that. And so for the purposes of what we're doing here, I'm just taking each of those figures for inventory and receivables and putting them in there. And we'll also look at the change in the payables, which we will take from the balance sheet as well. And so the payables figure here, again, we're copying it up, both figures over here, and we'll end up getting the difference between those figures for each year added up. The next one then, which is G in this case, is going to be the long-term loan again. So we've taken that out just to put it back, which is something that's done. With taxes, we need to look at the cash paid over. So the total amount in the income statement will include potentially taxes that are owed. So a quick check in the current liabilities will show us if there's some amount owing. And if there is, it's going to be the difference between those two figures that'll represent the cash amount that's actually been paid. And again, that's just tied in H in this case. Next, we have the cash spent on acquiring capital assets, warehouses in this case, and we're going to look at the difference between each year's figure to see if there's been more money spent on them, or indeed, in certain situations, they might be sold off. If there's a change in the share capital year on year, that will indicate that more money is being taken in, or if there's been a share buyback, sometimes it could be money paid out. If repayments have been made on a loan or additional loans have been taken out, then there'll be cash flow from that, which is denoted by K. And so we're looking at the difference between the balances on the long-term loan in this example. And finally, if we pay out dividends to our shareholders, then those dividends are going to result in a cash flow out. So again, in this case, it's L, and that's everything that's needed in a cash flow statement. So here's an actual question example now. So you'll see from the layout, it's the same. You're presented with an income statement and a balance sheet, and you also have a layout for it. So we're going to look in first and foremost for the profit before tax in this case, and so that's slotted in as the first figure that's used there. We then have the add backs of depreciation and interest. So for depreciation, it's going to be the change in the figure from year to year, as we mentioned. So it's the 60,000 minus the 28,000, which tells us depreciation charge for the year was 32,000. And so we're going to add that back as the first add back. The interest expense comes out of the income statement and is €5,000. You can see it there, and that's also added back. This then gives us our starting figure of €338,000. So next we will need to find the changes in inventory, receivables, and payables. Both the inventory and the receivables will come from the current assets. So we take each of those figures over. And in this case, we have 76,000, 78,000. We then go back for the receivables out of the current assets, which is 84,000 and 44,000, and we slot them in as well. Then we go and get the payables as the last figure there and bring that through to the cash flow statement as well. Now the payables are going to be negative figures, so you can see here when we bring them over, they are minus 67 and minus 50,000 respectively. So once we have those figures, what we can do is take each one of them and first add up the years. So we end up with 93,000 and 72,000 in this case. So the additional amounts invested in working capital total is 21,000, which means the cash that we've generated from operations is going to be €317,000. We now need the interest paid, so we have that already directly from the profit and loss account, so we just slot that in. We need the taxes paid. Now we have taxes that were due here of 37,625. but in the balance sheet there's still €2,700 owing. Therefore, we have to subtract that 2,700 from the 37,625, and that tells us in cash terms we paid out €34,925. So if we add both of those up, we end up with a figure of 39,925. And if we subtract that amount from the 317,000, that tells us cash from operations is 277,075. So now we're looking at the warehouses that were purchased, and you can see that the value of them was 935,000, but it's gone up to 1,100,000, which means that we spent €165,000 on it during the year. So again, that's money that's been spent, so we have to subtract that out. From there, we need to look at any changes in share capital, and in this case, the share capital has gone up by €100,000. So in that scenario, obviously subtracting one from the other gives you €100,000. That's 100,000 extra in cash in this case, so that's 100,000. The loans, which as I mentioned could be repayments, or in some certain circumstances they could be additional monies. In this case, it's actually additional money, so it's 100,000 was the loan this year, only 80 last year. So in fact, we received an extra €20,000 in loans for that period of time. So we're slotting that in. And then finally, from the profit and loss account, we want to see what dividends were actually paid for the year. In this case, that was €10,000. So that's just cash straight to the shareholders. So in that scenario, if we subtract the dividends from the share capital and the loan receipts, that tells us there's a net cash inflow from this area of €110,000. Subtract the 165,000 that was spent on the warehouses from the net cash from operating activities, and then add on the 110,000 to give you a net increase in cash of €222,075.